Welcome, Bruins, to tonight's First Gen Alumni Network event. My name is Ernesto Duran, and I am the First Gen Network Board Treasurer. We serve alumni from all backgrounds and ethnicities who are first in their family to attend and graduate from college. That also includes students and siblings for which neither parent has received a four-year degree in the United States. We provide social, professional engagement, and mentorship opportunities through events, networking, and community service. We recently hosted a bingo night and ran a very successful Spark campaign where we exceeded our goal to fundraise over $10,000. That has allowed us to offer small scholarships to our Bruins. I'd like to thank Wescom for participating in tonight's program, Income Planning for the Future. And now I would like to introduce Sal Murguia from Wescom.
Thank you, Ernesto. Good evening, everyone. My name is Sal Murguia, Partner Development Representative with Wescom Credit Union. We're happy to be here tonight to provide this wonderful presentation for you. Joining me this evening is Carl Gerstenacker, who is the Financial Advisor with Wescom Credit Union, and David DJ Jabzinski, who is Director of Investment Services. And before I hand it off to both DJ and Carl, I just wanted to let all of you know why Wescom and UCLA partnered together, so you can get a better understanding of our partnership with UCLA. So I'm going to share my screen. So Wescom Credit Union, better banking for Bruins. Wescom was established in 1934. We are one of the largest credit unions in Southern California. A credit union offers similar products and services as a bank, but like other credit unions, Wescom is a non-for-profit cooperative, meaning the profits that we take in, we give back to our members in the form of lower fees and lower rates. Being one of the largest credit unions in Southern California means that we have multiple branches to serve you in our area, which includes 24 branches in Southern California. About 5 years ago, Wescom Credit Union and UCLA signed a partnership together, and we became the official banking partner of UCLA Athletics, Campus Life and Recreation, and the Alumni Association. So our job here is to build better lives for Bruins. We want to be a resource for the entire Bruin community that includes students, alumni, and faculty and staff by creating financial healthy habits, and we want to make banking easy for the entire Bruin community. Just wanted to let you know that you can bank with us from anywhere when you sign up and open up an account with Wescom. We have online and mobile banking, mobile wallet, Snap Deposit, and Zelle. And we also have access to over 30,000 nationwide ATMs, and that's fee-free ATMs for those of us who, or for those of you who open up an account with Wescom. We have lending options to fit your budget in terms of some of the opportunities that we have to give to you. So we offer mortgage loans, low rate auto loans, credit cards, home equity lines of credit, and personal lines of credit as well. One of the features that we had that we just signed up with, or that we established with the UCLA Alumni Association, is our Bruin Edge and Bruin Choice Visa cards. And the Bruin Edge card is for those who qualify that aren't UCLA students, but are part of the alumni group and those involved in the UCLA community. So it's a credit card program that has a 0% intro for 0% intro APR for 6 months. You can get 50,000 points after $200 or $2,500 spent in the first 3 months. You get 1.5 points per $1 spent, and then 5 points per $1 at various UCLA affiliated locations like the UCLA store, Rose Bowl Stadium, the Brookside Golf, Poly Pavilion concessions, and etc. So it's a great card. We've just started this year, and we noticed that a lot of UCLA alumnus have been pre-approved and signed up and taken advantage of the Bruin Edge card. Another product that I want to introduce to you is our 0% interest tech loan from Wescom. So in addition to the Bruin Edge and Bruin Choice card, this is an exclusive offer to the UCLA community. So if you're looking at upgrading your iPad, your iPhone perhaps, or needing some AirPods, you can qualify up for a $3,000 0% interest tech loan from Wescom at the UCLA Computer Store. One of your featured speakers tonight is Carl Gerstenacker. He's a UCLA alumnus himself, and he's your personal financial advisor from Wescom. This is an exclusive Um, this is an exclusive, excuse me, I'm sorry. This is an exclusive benefit that we have for all of our members, and Carl is the gentleman who will help you, serve you to help you out with any of your financial needs. So if you can make an appointment today with Carl, there's his email address listed, kgerstenacker@wescomfinancial.com, and you can reach him at the 888 number at his extension 1239. You can also visit us on either online, or you can go to our campus branch at Ackerman Student Union. So if you find yourself back on the UCLA campus, please visit us at our Wescom campus branch. We're open Monday through Friday from 10 a.m. to 5 p.m. Again, we're located on the first floor, and you can meet Martha Prado, who is the branch manager, and her friendly team, and they'll help answer any of your questions about Wescom and your Wescom account. Tonight, we want to encourage you to participate in our conversation. So if you participate, you may win a $50 UCLA store gift card. So participate, win, put some questions in the chat or raise your hand, and we'll be happy to help answer your question. And one of you at random who participates will be the recipient of this card. Please contact us at ucla.wescom.org or our 888 number, that's 888-493-7266. And with that, I just want to say thank you. I'm going to turn it over to our featured presenters, DJ David Jabzinski and Carl Gerstenacker. DJ, Carl, please feel free, take it away.
All right. Well, good evening, Bruins. Hopefully everyone can hear me okay. This is David Jabzinski. Everyone hear me okay? All right. Perfect. And hopefully you can see my screen here. We do deeply appreciate you spending the next 30, 40 minutes with us going through some of the information here. As Sal said, we're so excited about the relationship between Wescom Credit Union and UCLA. And what we're going to cover tonight is some great information about income planning for the future. Whether this pertains today or something you're thinking about for tomorrow, we're here to give you great guidance, great information. And again, we want to equip everyone with some good financial planning tips for the future. So we're going to cover several topics over the next 30 minutes. We have about 28 slides to cover. If there's a topic that you want to ask a question or something that we're covering in the slide, feel free to use the chat box feature. Both Carl and I will be reviewing those and be responding to you, as well as we'll have some time at the very end for questions. So without further ado, let's get right to the presentation here. And I'm just going to do a quick introduction of Carl. Carl and I will be covering several of the slides back and forth here. But the topic tonight is income planning for the future. It's talking about planning for that successful retirement. What are some of the keys? What are some of the things to be thinking about? And so we're going to touch on those topics this evening. So Carl Gerstenacker, as Sal did say, is our official financial advisor to our UCLA Bruin. So very delighted to have Carl here. I'm the Director of Investment Services for Wescom Credit Union and oversee all of our advisors. And specifically tonight, Carl's going to be here to talk a little bit about this journey of planning for your financial future and financial retirement. So without further ado, I'm going to go ahead and turn the presentation over to you, Carl. Take it away.
Thanks, DJ. And thank you, Sal, as well, for the introductions. I feel like I don't really have to introduce myself anymore, which is good. Thank everybody for joining us tonight. DJ and I and Sal and everybody here, we hope that you guys take away some valuable information from this presentation. Like DJ mentioned, we're going to be focusing on retirement income planning and kind of present different ideas in terms of how to think about this as whether you're early on in your career or later on in your career, approaching retirement, a few things to think about and to help you prepare for that, right? So oftentimes when we're thinking about retirement, that may mean different things for people, right? For some folks, it may mean that we are not going to work anymore at all, right? We're thinking, hey, I've put in my time and I'm done working. I want to enjoy time with my family. I want to travel and just take on ventures that are more dear and close to your own heart, as opposed to maybe working the past, several decades For other folks, it may mean something different. It might mean retiring later on in maybe your 70s, or it might mean maybe working part-time, but that can look different for different folks. And so when you plan on retiring, I think is important when it comes to turning your savings or investments that you've generated over the years or accumulated over the years. It's important to know and have a good idea of when you're planning to retire, so that way you can plan on how you're going to be utilizing these savings when you do decide to retire. And so that kind of links to how long your retirement will last, right? The big question for most folks when they're transitioning into retirement is, do I have enough money to live and pay my bills, right? And sustain the same lifestyle that I like, and is it going to run out, right? That's a key question to think about. So we'll jump in and we'll discuss these questions here. Something to consider when it comes to retiring early, right? And by early, I'm thinking, guys, maybe late 50s, early 60s, right? And so when we decide to maybe retire early, it's a few things to consider, right? When you retire early, that means that the amount of years that we spend accumulating or saving, they're going to be fewer, right? And so a good example is if somebody decides to retire at 55 versus 65, right? That's a 10-year difference when it comes to the amount of time somebody is going to be saving or putting money away into a 401k, for example, at their current employer. So something to consider when you do retire early, you're accumulating or you're saving for less time. And then you're also going to have a longer distribution period, meaning that you're likely going to be utilizing these funds in your savings or in your investments for a longer period of time, especially with how, in recent times, we're living longer, right? With technological advances in medicine and things of that nature, we are living longer. So then our retirement accounts, our retirement funds do need to last us a longer period of time. And that's even more true when we retire early, right? And so when we also decide to retire early, that has an impact on our Social Security benefits, right? We'll dive into this a little bit later on, but there's certain ages where they're significant when it comes to starting your Social Security benefits. We can begin at 62, but then we need to weigh the impact on doing that versus waiting till our full retirement age, whether it's 66 or 67, simply because at 62, we will get a lower amount. Again, something we'll touch on as we go along. Again, healthcare, Medicare, right? Health insurance, when you're employed, oftentimes if you're employed for a company, they'll cover a significant portion of that cost. And so how will that look like if you retire early? Where will that health insurance come from? And then if you're fortunate enough to have a pension benefit at your current employer, how will you retiring early have an impact on how much you'll receive? So again, a couple of things to consider when you're deciding whether you want to retire early or continue to work on into your mid to late 60s. And so if we're delaying retirement, it's pretty much something that is the opposite of what we were just looking at, right? We have more time. When we decide to delay retirement, we have more time available to us to put money away. Oftentimes our prime earning years are going to be those years where we're close to retiring, right? Where we've worked many years prior, and the time frame when we're maximizing our income from employment tends to be as we get closer to retirement. So those are, I would say, important years to save and to put money away. And you'll have more of those if we retire a little bit later. Shorter distribution period, meaning that we won't need to be pulling money out for as long, right? If we're retiring a little bit later in our 60s or mid 60s. And obviously, you get a higher amount the longer that you wait for Social Security, right? And then obviously waiting till 65 to begin Medicare will potentially put you into a position where maybe you save some money on health insurance when you start drawing it from Medicare. And so oftentimes, like I mentioned at the beginning here, that most folks, or not most folks, but a lot of folks will say, hey, you know what, Carl, I don't really want to fully retire, right? I do want to still maybe go part-time at my current employer, or maybe look for a different job or a different venture that can provide income. And I'm kind of doing more so of what more of a passion or more of a job that you value more on a part-time basis. And so the benefit of that, right, is that you earning funds from wages, right? You earning an income from work and from wages allows you to maybe add more to these retirement accounts that you've been adding to for years, and it puts less demands on you needing to use your savings to fund your retirement if you're still getting paid from work, right? And so that's a benefit oftentimes that we see when folks decide to work to retirement. You potentially have access to health care or health insurance, right? Through an employer, even if you're working part-time in some cases. One thing to keep in mind with Social Security, depending on when you decide to begin taking Social Security, remember you can start at 62, right? That would be considered taking it early, but that is when you could begin. If somebody decides to take Social Security before their full retirement age, and decide to also work and earn, I think right now it's about $18,000 or more, your Social Security benefit starts to get affected, right? If you decide to take Social Security too early and you're still working, that may have an effect on the amount of Social Security that you receive while you're receiving it before your full retirement age, which for most folks is 66 or 67 years old, right? And obviously working during retirement can have, non-financial benefits, right? Just the fact that you maybe are spending time with folks that you built a relationship with, coworkers, and just having activity throughout your retirement can obviously be a good thing when, when transitioning to maybe not fully retiring, but kind of just maybe slowing down on the amount of work that you're doing. And so we'll jump on to the next slide if you like, DJ here. So again, one thing a very important factor to think about when you're transitioning into retirement, or starting to think about it at least, is longevity, right? How long will it last, right? And so, like I mentioned earlier, we are living longer, right? The average 65-year-old American can expect to live an extra 18 to 19 years in retirement, and so, when we're talking to members or clients or folks in general about how to plan for retirement in terms of their nest egg and how much income they might need, we're usually planning for the retirement to last 25 years or more, right? I often tell folks that when it comes to saving or investing towards retirement, we want to expect a longer retirement, simply because we want to ensure that you have the sufficient funds needed to fund retirement through, years of inflation, right? When the cost of items are going up, and even, in times when investments aren't performing well, we want to ensure that we have sufficient funds there to supply you with income every month when that paycheck isn't coming in anymore from work. And so when we're thinking about, planning, right, and what our objectives essentially are, right? When we're planning for retirement, the idea is that we want to try to have the funds sufficient to enjoy retirement, right? To enjoy, things that you value, things that you feel are going to be continuing the lifestyle that you want. But at the same time, we want to make sure that whatever savings that you have or whatever investments you've accumulated, we want to manage the risk of outliving that money, right? We don't necessarily want us to be overly concerned or react necessarily to investment performance, right? If your investments aren't necessarily performing well, risk is going to be a part of investing always. So we want to make sure that we manage that, so that way you don't are concerned with outliving your savings. And obviously, we want to also manage the risk of unexpected life events. Oftentimes, that means a lot of health issues, right, or health concerns, health costs that come into play later on in retirement, and making sure that we manage that we save and then we invest, so that way we're not having to worry that's going to derail our plan for retirement. So we're going to kind of click through these. When we're thinking about planning, right, for income that we're going to need in retirement, oftentimes obviously we want to figure out how much money we're going to need, right, in terms of paying bills and our expenses every month, right? So that's oftentimes when we're planning with members and with clients, the first box we want to check off is income, right? How much income are we going to need to ensure that we continue the lifestyle that we want, and is it sustainable, right? And so that's the first thing that we'll talk to folks about, and that's the first thing that most folks want to talk about anyway, in terms of how much income they'll need. You want to also consider factors that are going to affect your retirement accounts, your savings, your investments as you get closer to retirement. Things like inflation, right? The cost of things going up, market risk, right? How are my inflations gonna react to certain performance, right? And then the next step here is that we want to kind of get a good snapshot of what our income benefits are going to be from Social Security, which most Americans are going to be receiving if we paid into the system. And if you're fortunate enough to have a pension, what does that look like at a particular retirement age, right? And so oftentimes those two, if you're fortunate enough to have a pension, and then you have Social Security, which is essentially another form of a pension, the next step is identifying what's the gap, right? If my expenses are X and I'm receiving Y, well, what is the difference between those two? What is it that I'm going to need to fill that gap of income to satisfy my expenses every month? That's where your investments and your savings come into play, right? So that's where we kind of figure out how much income is sustainable to withdraw to make sure that it lasts you throughout your retirement. So again, in terms of trying to figure out how much income you'll need, right? Essentially, a general guideline, and again, guys, this is going to be a very general rule of thumb. A very general rule of thumb to think about, at least to kind of get the ball rolling with this, is you want to ensure that you have about 60 to 90% of the income that you were generating before you retired, right? Again, very general guideline. I don't tend to lead with this because I feel that everybody's individual situation is going to be very important, right? Somebody could be in a situation where maybe their mortgage is paid off before they transition into retirement. That'll look, from an expense standpoint, that's going to look much different than if somebody is they have rent, right? You're paying rent every month. That will continue in retirement, so we have to plan for that, right? So those, again, kind of a general guideline, 60 to 90% of your pre-retirement income, but again, it'll be different for everybody. So I think a very important thing to do 5 to 10 years before retiring is having a solid idea of what your expenses will look like when you transition into retirement, right? And so that'll give you a good idea of how the assets that you've saved, right, the savings and the investments that you've accumulated, how that will provide you with income when you do decide to retire. So DJ, I will turn it over to you.
Okay, thanks, Carl. I'll give you a break here and I'll take the next couple of slides. So as Carl was discussing fixed costs, and one of those costs, of course, once we hit retirement, is healthcare costs. So when we go to work for an organization, no matter what type of industry that is, hopefully they'll have health insurance, and most organizations do. Of course, if you have your own business, then you do have to go out and purchase that. But once you get to retirement, what is that bridge for your healthcare? So there is what is called Medicare. So Medicare kicks in at age 65. So if someone typically retires from an organization at 65, they'll basically go on to Medicare. So again, it is set up for those that again, are looking for some sort of healthcare plan. Now, not only is Medicare a healthcare plan, but it does cover, senior physician, maybe at 65 and older, you're want to do certain type of tests, of course, to make sure you maintain your health and your physical status. So again, there's a lot of different things as it goes into Medicare. So typically what will happen is once you receive Social Security and you do sign up for Medicare, they will have a part of that will get deducted, and that will help fund your Medicare policy. Medicare does not cover long-term care, so that is another expense and something that Carl and our team at Wescom can help someone plan for. And then there's also what is called Medigap policy. So what's a Medigap policy? Well, think of this. Let's say once we retire at age 65, our Medicare policy is going to cost about $200 per month. Now, when we pay that $200 per month for Medicare, what happens is there's still what is called a deductible, meaning that if we go see our physician, they still may charge us $30 or $40 or $50 in a deductible that we pay. And so having a Medigap policy basically helps exactly what it says. It provides that gap in your policy. So there is different coverages that are out there. So typically once someone hits age 65, that's something that they definitely would want to do, is sit down with someone to just give them financial advice on, hey, what do I need to do to make sure that my healthcare is covered as I go into retirement? Now let's look a little bit further at additional Medicare benefits. Now, again, Medicare does not cover long-term care, and long-term care is something else that Carl and I know we discuss a lot when we sit down with individuals. Now, when you think about long-term care, and again, it's probably not on anyone's mind because, again, like all of us, especially living in Southern California, people are very active. They're out, they're working out, they're hiking, yoga, all these different things. So we never really think about long-term care. But here's what I want you to think about, that again, going into a long-term care situation is a big, big cost. In fact, if you look at some of the what they call semi-private rooms in a nursing facility, it's about $93,000. So extremely costly. Now you may be saying, okay, DJ, what's a semi-private room? Well, that is where you basically may share that room. And again, it's all for your long-term care needs. Now, what's interesting with some of these long-term care policies, as well as what people are doing now, is they're saying, you know what, it may not be what we have read in a book, or maybe a parent or a grandparent that may have been in one of these long-term care facilities. I know some of the stories that we've heard 20, 30 years ago, quite different than they are today. In fact, some of these long-term care policies will do what is called in-home care. So for an example, as Carl mentioned, maybe the individual we're working with, they're able to stay in their home, but they just need help with, maybe it's just cooking and doing some things around the house. So some of these Medicare, or I should say long-term care policies, will actually start to cover in-home care. So that way someone can stay within their home as well as have someone come in and help them. There's also what is called Medicaid. Now, I don't know if anyone has heard of that term Medicaid, but Medicaid is something where if you meet certain low income thresholds, you may be able to qualify for that and basically help with some of the long-term care costs. So very important to make sure that you are working with a financial professional, because again, Medicaid is one of those things where you have to have a certain level of assets and income in order to qualify for that. If you do not qualify for Medicaid, then it's important to make sure that you have your own policy. So very important as you go into retirement to understand medical and long-term care costs, because again, we want to make sure that this is not a derail someone's retirement because of the fact that there's some sort of long-term care situation. So definitely many factors to consider. And again, in addition to some of the Medicare costs that potentially could happen in retirement and long-term care costs, other things, and I know Carl talked about this, is accounting for inflation. I know just going to the gas pump right now and trying to fill our cars is just unbelievable, the price that we're paying at the pump. So that's another thing to consider, the cost of food and different things such as that, and as well as impact of taxes. Taxes, of course, are continuing to seem to go up, and so it's important to make sure that we just have a good understanding of what those taxes are. I just mentioned inflation. We know inflation is going up. In fact, for many years, inflation has been going down, but just in the past year, since the pandemic, it seems like things have been very challenging from an inflation standpoint. So it's something we definitely want to consider as we do retirement planning, and just know that on average, inflation has been around 3%. But what we've seen in the last 12 months is some of these numbers for inflation are 5 to 6 to 7%. And so things that we have not seen in quite some time. So it's very important to make sure. And again, just think of inflation as purchasing power. Is my dollar today worth the same, if we go out a year from now? So it's very important to make sure that, with the rising cost of milk and just going to the grocery store and purchasing things, we want to make sure that we're keeping up with the cost of living, as they call it. We talked about this briefly, but the impact of taxes. So once we get to retirement, whatever that is, if it's in our 50s, our 60s, or 70s, we're going to be in different tax brackets. Hopefully, you'll be in a lower tax bracket. That is the goal. But we may not be in a low tax bracket. We may have capital gains that we have to consider. So again, thinking about ways to reduce our taxes before we get to retirement will be very, very important. There's ways you can do that. Tax-free bonds, there's other accounts, which we may touch on this evening. And if anyone has a question, there's different type of retirement accounts. Individuals have 403Bs, 457s. There's Roth accounts where money can come out tax-free. So these are all the things that you definitely want to think about as you get to retirement, because they could impact your tax situation. So Carl, I'll turn it back over to you to talk about risks.
Thanks, DJ. So kind of going along with what DJ was mentioning, another factor to consider would be risk, right? So when we're transitioning into retirement, oftentimes, or at least preparing for it, oftentimes we have to evaluate what type of risk we're willing to take, and oftentimes it's less, right? And so throughout the accumulation years, when we're putting money away, we're saving, we're investing, the goal is to try to grow your nest egg as much as possible. But as we transition to retirement or get close to it, oftentimes what we're doing is we are reducing the amount of risk, right? Market risk is in reference to your investments fluctuating because of the stock market or because of the bond market. If you hold any sort of CDs or kind of fixed type of investment vehicles or account types, reinvestment risk means that you were maybe receiving a certain interest rate at the time when you opened a particular account, but then let's say that investment matures, but now interest rates are lower, right? And so that essentially is a risk, because now we're earning less on that money that you had in another particular account before, another investment. So a couple of different risks to consider when you are transitioning into retirement. Interest rate risk is the idea. We're kind of seeing it now, right? The potential for interest rates to increase will decrease the value of certain investment types, whether it's bonds, most notably, sometimes even stocks, right? It affects the stock market. So kind of different things to consider when you are transitioning into retirement for your investment accounts and your savings. And so we'll transition a little bit here, guys, in terms of how to think about. We talked about this a little bit earlier in the presentation. We reference what's called kind of a three-legged stool when it comes to preparing for the income that you're going to be bringing in when you're retired, right? Oftentimes, most folks will receive Social Security as one of their income amounts. Again, if you're fortunate enough to have a pension available to you, that will be the other income source. And then the gap that we talked about, the amount of funds that we'll need to fill the rest, right, to cover expenses, that'll come from your individual savings and your investments. oftentimes 401ks, IRAs, retirement accounts of that nature. And so when we're thinking about Social Security, right, again, like I mentioned earlier, we could begin receiving Social Security at 62. However, if we do begin at 62, it will be about 25 to 30% less permanently than what we would receive at our full retirement age. Full retirement age for most folks, depending on the year that you were born, is 66 or 67 years old, right? And so a very important thing to consider and kind of do your homework on what might make sense for you in your particular situation when that time comes. You know, working in retirement, like I mentioned earlier, will impact your Social Security benefit if you begin receiving it before your full retirement age, right? I think one thing that is beneficial with Social Security in either event is that you will oftentimes receive a cost of living adjustment if we see that inflation is increasing, right? The Social Security Administration will give you an increase, not every year, but kind of depends on kind of how the cost of living is going. But oftentimes we'll receive an increase on our Social Security benefit based on kind of what the inflation rate is and what we see in terms of cost of living, right? I wouldn't depend on it, right? It's not guaranteed, but it depends on kind of how things are going. I think the important thing here is to remember that even from its roots, right, from the beginning, Social Security was never designed to be your only source of income. It was designed to be a part of it, right? And so that's where things like a pension or your investments or your retirement accounts come into play. And so we'll go on to this next slide here. Again, pension, if you're fortunate enough to have one, there's different. A pension essentially it's an annuity, right? It's you annuitizing an annuity, meaning that you will receive a monthly benefit amount. And oftentimes the calculation is depending on the years of service that you had for that particular company. If you're married, right? If you're married, most employers will mention that there is a benefit to your spouse if something were to happen to you. Payments oftentimes will continue on to your spouse, but a lot of pensions, again, depending on the company that you work for, or the municipality that you work for, oftentimes it'll just be between spouses. If you're not married, then in many cases you're unable to put a beneficiary. It's just based on your own life. Again, depends on the employer. And then sometimes your employer will give you the option to actually take a lump sum of that pension. Instead of getting monthly payments, they'll give you the option of just taking one lump sum and then transferring it out into, oftentimes an IRA, and you can choose to invest that money however you'd like, right? And again, that's where somebody like me would come into play and help with the choices and with planning for that. DJ, we can go to the next slide here. Again, so if we're in a fortunate position to be able to receive Social Security and a pension, then we have to fill that gap, right? That income need with our savings in our other retirement accounts. So even if you don't receive a pension, right? If it's just Social Security, well, then what's going to finish funding your income every month is likely going to be money coming out of your savings or your retirement accounts, right? And so there are different things that you could do, different choices on this next slide here. So most times when we're talking about savings, when it comes to retirement planning, it's not necessarily money that you have in your savings account or your checking account. That's part of it, but most often we're talking about your retirement accounts at your job, 401ks, 403bs, IRAs, right? Roth IRAs. Those are your retirement accounts. Those accounts are designed to be used in retirement and essentially deferred and not used while you're accumulating and while you're adding money to them, right? And so depending on the type of investments that you have in these retirement accounts, that will kind of dictate how much they grow. And then once you get close to retirement, in terms of how much you're pulling out of those accounts for income, that is something that you want to strategize with to ensure that you don't run out of money throughout your retirement. So we'll jump into this next slide, DJ. And so again, when you're, like I mentioned, when you are saving and investing, when you're working and you are many decades away from retirement, the goal is to accumulate and to invest, to save, and to grow your nest egg. As you get close to retirement, you start to change your strategy and maybe go a little bit more conservative. And then when you do retire, the goal is completely different. Right now, we're not accumulating, we're not saving, we're not adding anymore. Now we're taking money out, right? And so your investments will look differently when you start to do that, right? And so planning for that and investing in investment vehicles that can ensure that you're not going to run out of monthly income, regardless of what happens in the stock market or regardless of how long your retirement is. That's an important thing to understand and to talk to a financial advisor or a financial professional that can help with that. So different investment tools or vehicles. We won't spend too much time here. If you guys have questions on this, we could definitely talk offline or we can set some time aside. But I mean, there's different investment vehicles that we can use once we're investing either in retirement accounts or outside of retirement accounts, right? There are what are called mutual funds that have stocks and bonds inside of them. There are dividend paying stocks. There are annuities, which are going to be on the next page here. But they're different type of investment vehicles that can satisfy different goals, right? There are annuities that can provide lifetime income that you don't have to worry about running out of, but still keep your money invested and grow over time. And so again, the idea is that we want to strategize and figure out of the savings and the retirement accounts that you've put away over time, when you transition into retirement, how do we make that into monthly income, right? And that's where these investment vehicles come into play. And so a kind of general rule of thumb when it comes to how much to pull out, right? Again, oftentimes it's going to depend on the situation, but a good rule of thumb is typically anywhere from like the 4% rule, right? 4 to 5%, where we're withdrawing that amount from the account every year. That's considered maybe a sustainable withdrawal rate, where pulling that amount of money out is sustainable in the sense that we won't run out of money in that account throughout our retirement. Again, a lot of that's going to depend on the investment types that you have, but a good kind of rule of thumb to think about when it comes to how much to pull out. And in terms of the order of withdrawals, I personally don't think there is it's very situational, right? It depends on your personal situation, on what accounts you should be pulling from, right? Should we pull from a 401k or an IRA or a Roth IRA or a regular stock account or mutual fund account? Where should we pull from first in terms of income? Again, that's going to depend on your personal situation, your personal tax situation, and that, through conversation, through planning, you can kind of see at that time what would make most sense. Whenever you guys see the word tax deferred, oftentimes that's going to be in reference to, employer retirement accounts that you can get at your job or a traditional IRA, right? Tax-free or tax exempt are going to be things like Roth IRAs, Roth 401ks. Whenever the word Roth is in front, that essentially means an after-tax retirement account where your money can be invested and grow tax-free for you for down the road. So DJ, I will turn it over to you. I think we have a question, but we could take the question or we can finish off and then do questions. Up to you.
Yeah, we're pretty much at the end of the presentation. I think we have just a couple minutes before we get to Q&A. Anna had a question here, and I think you may have answered it. What is the age in which you must start withdrawing from your retirement plans? You can see on the slide here, it is after age 72. And keep in mind, this is a recent change. It was age 70. So now it's age 72. And so that is the age. Now, what's interesting is at age 72, it's not a requirement to take 100% of that out. Basically, there is a distribution, flow, if you will, that actually gives us exactly the percent that you need to take out. So, to be in a situation where you only need to take the minimum out is an ideal situation. But again, that age is age 72.
Yeah, exactly. Anna, sorry, DJ, real quick. I think it's an important thing to know that if you, that age, 72 will apply to any, pretty much it won't apply if you're currently still working and you have a retirement account there at your employer and you continue to contribute. It will apply though to any pre-tax retirement account in which, you know, it's not through your current employer, right? So it's something to keep in mind.
Yeah, it's a great point, Carl, because again, you know, we work with individuals that continue to work. They may have a hobby or a home business and they're still working. And again, that's a great point. So let me just go to this final slide here. So this is just kind of a recap of what we covered this evening. It's 6:45, and I always want to make sure we're prompt on finishing on time. But we do have some time for questions. And so I'm just going to go ahead and put Carl's information up here on the screen. And I would just want to close on this is, as I did mention in the very beginning, Carl is your financial advisor dedicated to UCLA students, faculty, staff, alumni. We deeply, deeply appreciate you spending time with us this evening. So on that note, I'm going to go ahead and turn the presentation back over to Ernesto.
Thank you so much, guys. This isn't meant to be a commercial, but I am proud Wescom Bruin Edge credit card holder. So thank you, Bruins, for joining us tonight. Again, thank you to Wescom's Sal, David, and Carl. We hope to see you at future First Gen Network events. Have a good evening and go Bruins.